Charlene Watkins Bird. Charlene Watkins Bird came on. Basically, she was a loan processor prior to becoming joining the First Home Alliance team, and it is she's very thrilled to help open the doorway to homeownership and look out to help you promote yourself from where you are now and to basically building wealth for your next generation. Charlene work with the First Home Alliance during the last financial crisis that we have. And a matter of fact, one of her kids got the name of Mr. Foreclosure, where Charlene actually gave birth a few hours after a workshop that we had there in Prince William County, which was the hardest hits with the foreclosure during that time period. So it's a welfare experience, helping families through hard times and also helping them realize the American dream. And she's now a first time home buyer, and she can walk you through that process as well. And so without further ado, I would like to introduce you to our loss mitigation specialist and senior housing counselor, Charlene Watkins Bird.
Thank you so much, Larry. And again, thank you everyone who is out there viewing. Thank you to the people that we have online. Hi, Miss Shay. Hi, Kim. Thank you so much for joining us this evening. Today's agenda, what we're going to talk about. You'll notice if you've been a part of our webinar series, it is a series, the classes that we provide them every Thursday, as Larry has stated before, at 7 p.m. And so with this series, that I'm going to call it really a loss mitigation or foreclosure prevention series. And so every time we have a class, I kind of like to recap the class that we had before that, so you understand kind of the method or the way that these programs work from the very beginning to the very end. And so we're going to recap forbearance. We're also going to recap talking about a repayment plan. What is it? And then we're going to get into the topic today is how do I qualify for a loan modification? What is a loan modification in itself? How does an individual qualify for that? I think one of the biggest things with a loan modification, and when I look at our clientele and just people in public, period, they want to know, if I go for a loan modification, how is this going to affect me in the long run? And then the last thing, should I move forward with applying for a loan modification? Next slide. And we got all these pretty little graphics again. What is it? And be careful and all that good stuff. So in case you missed it, let's get into this recap. All right, so what does forbearance mean in the lending world? So forbearance in the context of mortgage and the mortgage process in itself is a special agreement between the lender and the borrower to delay foreclosure. And I think, and every time we have this class, I really hone in on that part right there where it says to delay foreclosure. So a forbearance just simply means that servicer or that investor is just holding back that process of putting that file or putting that portfolio or that home into the foreclosure process or the foreclosure department. So again, what does the forbearance mean in the lending world? Forbearance in the context of mortgage, the mortgage process is a special agreement between the lender and the borrower to delay foreclosure. What does that mean in English? Again, forbear, to hold back. Okay. Who right now are offering a forbearance in the CARES Relief Act? And so you got your 5 major investors who immediately decided, hey, we know there's a lot of people right now who are being affected by the pandemic, the coronavirus. And so these top 5 investors immediately came up with a product, immediately came up with a program to help individuals sustain home ownership. And so the top 5 players we have is Freddie Mac, Fannie Mae, VA, the U.S. Department of Veterans, USDA, and HUD.gov. So the VA loans is the U.S. Department of Veterans. So you got Freddie, Fannie, VA, USDA, HUD.gov, and also I don't see here, but FHA. And so that's probably what stands for HUD.gov. But these 5 players immediately offered a product, immediately offered a program as soon as when the CARES Act was passed to help individuals who are experiencing a financial hardship sustain home ownership, or to put them in what we call a forbearance or a special forbearance. So you chose the forbearance. Now what? Meaning, somehow, some way, this coronavirus affected you. It affected your family in some capacity. It affected your income in some capacity. And so you contacted your servicer, or excuse me, you contacted a HUD approved housing counselor first, right? You went to HUD.gov, you put in your zip code, you got a HUD approved housing counseling agency in your area, and together the two of you reached out to your servicer. You applied for this forbearance, you were approved for the forbearance, and you were given this for, you know, that 180-day period. Side note, remember, it runs for a full 12 months if need be, excuse me. And so fast forward, that 12 months has come and gone. So you chose that forbearance, the time frame has passed, and now it's time to say, what's my next step? What I'm going to do now after I've received this forbearance? The biggest thing that Larry and I keep honing in on and keep saying is forbearance, not forgiveness. And every time we have a webinar, every time we have any opportunity to educate our community, we really want to hone in on this part right here, because I think this part right here will be the divide between the individuals who are able to sustain and the individuals who unfortunately may end up foreclosing. Is because you have to understand that the money at some point in time must be repaid. Okay, so you got that forbearance. Now what? Now the servicer or your investor is like, okay, now I need my money. So now we're going to look into what we call the loan repayment plan. So how does a loan repayment plan actually work? All right. So next slide. How does it work? So this is the most popular and most widely available product, so to speak, in terms of your programs to prevent an individual from experiencing foreclosure. So this is this is the most popular, most widely available mortgage repayment option. With a repayment option, you will make a monthly repayment. And I'm sorry, I somewhat see my slides, but then I somewhat don't see my slides. Okay, so with the repayment plan, you'll make a monthly repayment for an agreed period of time known as the term until you pay back both the capital as well as the interest. I know some people are thinking, like, why is this the most popular product or plan in terms of trying to get an individual back on track in reference to their monthly payment? And so from my experience, I'm going to say the reason why it's the most popular, guys, is because you don't touch anything. You basically go back to the way it was. You come up with an agreement. So let's just use some even figures, right? So say, for example, that monthly payment was $1,000 and you forbeared it for 6 months, so you now owe $6,000. You divide that by a specific number, so it may be 6 months. It usually caps out at 12 months. So a repayment plan usually doesn't extend past that 12-month mark. So what they do is they divide that dollar amount by the number of months that product you're given that product. So whether it be 6 months, excuse me, whether it be 3 months, whether it be 6 months, or whether it be 12 months, they divide it by that number, and they take that dollar amount and they now add it to your monthly payment. So you could have been paying $1,000, and now instead of paying $1,000, it equates to a person having to pay an extra $250. So that monthly payment will go from $1,000 to $1,250 for the duration of the term that you and the servicer has agreed upon. So the best part about the repayment plan is at the end of that 3 month or 6 months or 12-month mark, you go right back to your regular monthly payment. So if that regular term was $1,000, then you go back to paying $1,000. People like this particular product for the simple fact that it does not restructure the note. So imagine individuals, and I know, you know, even our clientele, we have some, and I'm quite sure there's a lot of people who are right on the cusp of having a mortgage completely paid off, right? So you've been in this house 27 years and you're in the transportation industry, you're in the travel industry, and all of a sudden that income that you had is no longer, right? But you had only a good 3 years left for this home to be paid for. You don't want to mess it up or possibly lose it or restart the whole product or the whole program or the whole note. So that would be a good product for a person who's in that situation where I don't want to mess with the terms of my note. I don't want to restructure anything. I just want to take the dollar amount that I owed, pay extra each month until I pay it off, and go back to the business as usual. So that's how the repayment plan works, and that's one of the reasons why it's so popular. Let's go to our next slide. So what if that repayment plan is not an option for you? What if the income does not support a repayment plan? Because I think in our class, when we talk about the repayment plan, I think one of the things that we hone in on is the fact that with the repayment plan, you have to demonstrate the ability to actually repay. So it's not where I can just contact that servicer and say, hey, I'm back to business as usual. I can afford an extra $250 a month, or I could afford an extra $600 per month. It doesn't work like that. I have to actually demonstrate and show them through my finances or financials that I actually can afford the extra $250 or the extra $650 per month. So again, what do I do if I can't prove that? If I don't have it, there's a strong possibility there's a lot of us that are going to go through hardships in the next 6 to 12 months, even 24 months, because truth be told, we're all in uncharted waters, right? We don't know exactly how long this is going to last. So what if in 6 months or 12 months, my situation looks more dire than it does today? Now what do I do? What are my options? Next slide. So now what do I do? I want to look into what we call a loan modification. Okay, a loan modification. Let's go to the next slide. Let's talk about what is a loan modification. So a loan modification, a mortgage modification is a process where the terms of a mortgage are modified outside of the original terms of the contract agreed to by the lender and the borrower. In general, any loan can be modified, and the process is referred to as a loan modification or a debt rescheduling. Next slide. Getting a mortgage loan modification could mean the following. You're extending the length of your term. So remember how I said why a person who is almost at the finish line, they can see where that house is now theirs, why they may not want to look into a loan modification because they don't want to start over. So that's one way that a loan could be modified. You extend your term. Another way, you're lowering your interest rate, or you're changing from an adjustable rate mortgage to a fixed rate mortgage. Again, I want to always compare reasons why you would and why you wouldn't. So lowering your interest rate. What if right now you're one of those people, which there's a select few, who has a 3.2% interest rate, or who has an interest rate that is under 4%? You don't want to necessarily mess with that, right? So you would try and possibly look into those other options like the repayment plan. Again, it changes it from an adjustable rate mortgage to a fixed rate mortgage. Through the terms of your modification, though the terms of your modification are up to the lender, the outcome is lower, more affordable. The outcome for the modification, the basis of it, guys, is that lender is trying to make this sustainable. They're trying to make this where you couldn't afford it prior to the loan modification, and now with them restructuring this note, they now can see how this will be an affordable note, or what we call it in my world is a performing portfolio. Okay, and I hate to be so rigid with that, but that's what that investor is looking for. They're looking for a performing note. And yes, you guys are, real people with real families and this, that, and the third, but sometimes I think we have to look at it from a business standpoint, and that is what that investor is looking for. They're looking for that portfolio to perform. All right, and so that's the purpose of this modification. Again, foreclosure is a costly process for the lenders. So many are willing to consider a loan modification as a way to avoid it. I want to say when we were doing this in 2008, all I kept hearing is, why would they want to foreclose on me? Isn't there some type of insurance that will help them make money. So Larry, do you have any tidbits, any notes of questions that you may have received in that time frame where people would say, isn't there insurance that they get, so they make money or something of that nature, when a person gets in default? Do you have anything that you want to put in on that?
Yeah. Well, some used to say that the bank is going to make money anyway, and so they're going to get their money. So why can't they just not bother with me while I'm in the house? Let me stay in the house, and they're going to get their money later. One of the other things that they used to always say as well, on the reverse side, where people used to think that the bank wanted their house. Like, they want my house. They trying to take my house away from me. And like you say, before, it's not that they want to take that house away from you. They want to perform a note. And so that's what they want. But they don't want your house. And it's not all cases where the bank always get money as well. And I was just when you talked about loss mitigation, and that was one of the purposes of having that department there, is to mitigate their loss, and so that's one of the options in loss mitigation.
And guys, you're going to hear us kind of revert back to what happened in 2008, because for those in our industry who was around at that time, we can see some of the little things that are happening now that remind us of what happened in 2008. And basically it was an economic downturn, and it started, you would see some of the department stores that you grew up with, right? Some of those, I, I don't think Montgomery Ward or any of those was around, but there was some name brand stores that we would see in 2006 and 2007 that had been around for years and years and years to come. And it started with that, where they were filing bankruptcy and things of that nature. And we're starting to see that now. I want to say Lord and Taylor, um, who's been around for hundreds of years. Miss Shay, you're shaking your head because you've seen how, Lord and Taylor has been around for a very long time. Lord and Taylor is getting ready to go out of business. And so we're not trying to scare our community in any way, shape, or form. But what we are trying to do is get you prepared for what's to come. And especially for our homeowners, especially even for our renters, for our community in general, we want you to be prepared for what is to come. So we want you to know, what are the sources, what are the products, what are the programs available if I am one of these individuals who lose my source of income. And say, for example, I've been in the industry for I don't know how long. This is what I know. What if I lose that? I want to know, what are my options? What can I do? So we want you to take these classes, and we want you to find out, educate yourself exactly what you can do moving forward. So again, loan modification, it's going to basically, guys, it can restructure that note. It could extend that length of term of that mortgage. It could lower that interest rate. It could take you out of an adjustable, put you into a fix. And again, this is up to the lender. It's up to the investor. Okay. It's not up to us. It's up to your lender. It's up to your investor. And foreclosure in itself, guys, it costs the lender so much money. They are not in the business of property management. That's not what they do. They're in the business of putting people in homes and seeing notes perform. All right. So next slide. Again, how do I qualify for this? All right. I went through it. I decided this is what I need. This is what I want. Now what? How do I qualify for a loan modification? Number one, this is so important. First and foremost, an individual must be suffering for financial hardship. Larry can probably tell you a couple stories. I know I can tell you a couple stories. In the very beginning, 2006 and 7, when we started really seeing people come in, it was simply because they were upside down. Okay, so they would call us and they would say, hey, can I apply for a loan modification because I purchased this property for 500, but my neighbor got it for 350, and so can I go ahead and submit for a loan modification? And unfortunately, guys, that is not considered a hardship. So that hardship is the following: this may be a loss of job, a reduction in income, a serious illness, costly medical bills, a balloon payment due on your mortgage, meaning you got into one of these pick a pay or these exotic loans, and now all of a sudden you have to come up with $400,000 because the balloon is now due, a divorce, or excessive debt. So I really want to say this very loud, very clearly. We are in a great market right now, but if something happens and our market change and you're now in this property that you bought for 350 and it's now worth 200, that's not necessarily a qualifying factor for submitting for a loan modification, okay? So again, an individual must be suffering a financial hardship and you got to demonstrate it. All right, next slide. Number two, you have to show you cannot afford your current mortgage payment. So to qualify, lenders will genuinely expect your total recurring debt payments to exceed 41% of your gross monthly income, with your mortgage exceeding 31%. So it's very, very simple, guys. Take your gross monthly income, and please take notes, write this down. Take your gross monthly income, multiply it times 31%. And if that does not equate what that monthly mortgage payment is, meaning that number is a lot lower than what you're paying, automatically you're going to know, hey, I'm not eligible. But if that number comes out where it shows I'm paying 50% or 60% or 70% of my gross monthly income is going towards my housing, you very well could be eligible to submit for a loan modification, okay? I always say this too when I'm counseling our clients, that this is about sheer numbers. It's not really about anything else. A lot of times when we talk about finances and we talk about investors and things of that nature, you got to take the emotions out of it. So when you are looking to see if I'm eligible for a loan modification, you need to sit down with a pen and a piece of paper and put that gross monthly income on the paper and multiply it times 31% and see where do you fall. Okay, if those numbers don't match, then yes, I want you to go to HUD.gov. I want you to put your zip code in. I want you to contact a HUD approved housing counselor and see if they can become an advocate on your behalf and help you submit for a loan modification. Next slide. Okay, so number three, the property has to be your primary residence. And guys, this very well could change. I want to say that. Larry, if you want to chime in on investment properties, because I know with making homes affordable, at that time they did allow investment properties. And so if you want to chime in on
Yeah.
that, what your thoughts are.
Yeah, well, of course, we're in a financial hardship pandemic now, and the whole economy is experiencing this downturn. And so, if we just relate some of the things that happened in 2008, 2009, is that those investors out there, they understand that some of a portion of their portfolio is held by investors. Basically, they may call it absentee owners, and so they know that the absentee owners need relief as well. And so some of those lenders actually provided products and basically called those absentee owners and say, hey, we have this program that and a lot of times those do not come with no cost. They may be a fee or so involved, but they will offer those products to their investors, an investor owner, absentee owners, so that they can receive some relief in reference to their payments as well. So that is possible that lenders will actually provide those to individuals that is in some cases where it's not primary residence.
And I think we want to talk about that. And the reason why I asked Larry his opinion on that is because we know we've got data how the rental market and how tenants are experiencing a significant loss in income. And so for those who are watching this webinar, we're on Facebook Live. If you own properties, we definitely want you to know that there possibly could be products out there to assist you, because we have received the data that shows that there is a significant number of renters at this time who are unable to make their monthly payment. So who does that fall on? We know that that falls on investors. And so you want to keep yourself abreast as to what products, what programs are out here for renters, for investors, because we know that there are going to be a lot of renters in the future who may not have the income to sustain their monthly rental payments. And so We don't want to see our investors lose just as well. We don't want to see our primary homeowners lose. So again, keep yourself up to date as to products and the programs. Keep a good relationship, guys, with that HUD-approved housing counseling agency, because we're going to stay abreast as to what's going on. You know, when you call us, we're here to give you those resources, and we don't want to see anyone go to foreclosure. So again, keep that HUD-approved housing counseling agency on speed dial. But going back to this, the property has to be your primary resident right now. That very well could change. A lot of things could change as this pandemic continues to grow and things continue to evolve due to the pandemic. We can see some changes. But generally, the modifications are reserved for primary residents. But some private lenders possibly would be willing to modify a loan on a rental property. Next slide. So here's the biggie, guys. Know before you modify. How can this affect my credit? I don't think that if we didn't cover this, that we would be doing our community any justice, all right? So I think it's very important for us to cover the truth about a loan modification. A loan modification is an excellent product. I'm not saying it's not an excellent product. It's an excellent product to allow an individual to sustain. But there are some potential downsides to a loan modification. It may be added to your credit report. It could negatively impact your credit score. Now, we know with the CARES Act that the forbearance, at this time, they are unable to report any lates, okay, on an individual's credit report for up to 12 months. And this is a good segue for me to tell you how until the end of this year, you are able to go to annualcreditreport.com and pull your credit report weekly, okay? So every single week, you can go to that website and pull your credit report. Now, Larry, on that website, do you know it's just giving the activity or is it also giving scores?
No, it do not give score, just the activity on your
No.
credit report file.
Okay. And so again, it's just giving you the activity. It's not giving you the scores. If you want to know the scores, again, go to HUD.gov, put in that zip code, reach out to a HUD-approved housing counseling agency, because we are able to, of course, with a fee of $30, we can pull a tri-merge credit report and tell you exactly what is showing up on your credit report. We can give you the activity along with the scores, and that is a soft pull. And so if you want to know what soft and hard pull means, please stay tuned with our next classes because we always talk about that. But anyways, let's go back to this. It may be added to your credit report and could negatively impact your credit score. The resulting credit dip won't be nearly as negative though, guys, as a foreclosure. A foreclosure, it seems like to me, it probably can affect your credit report. I'm gonna say what, 7 to 10 years, Larry? It could possibly,
Yes,
affect your credit score. And
7 years.
7 years. And keep this in mind. I always say this. To me, your credit equals dollars. Okay, that score, you may see that 700 or that 640 or that 580, but try and look at a credit in terms of dollars. Because if I have a 580 and I apply for a loan, I very well could get approved, but my monthly payment could be 1,700. But if I have a 720 and I get approved, my interest rate could possibly a lot lower because my credit score is a lot higher. Instead of me paying 1,700, what if I'm only paying 1,500? So again, when you think about your credit score, I want you to always try and think and equate that to dollars. And again, keep up to the classes that we're providing, because we talk about credit and how it impacts us and things that you can do to improve your credit and things of that nature. But going back to this, I'm going to tell you real quickly, a lot of times with the loan modification, you have to demonstrate. Didn't I say earlier, you had to demonstrate the hardship, meaning in that world, to demonstrate means I have exhausted all options. Okay, so I can't call this lender and say I want to submit for a loan modification because I'm in a hardship and next month I make my payment. What you talking about? What hardship are you talking about? You just made your payment. I don't see that hardship. So when we talk about credit, a lot of times that's how the credit becomes negatively impacted, because that lender or that investor, they're never going to tell you guys ever, don't make your payment. Never. That will never come out of their mouth, and that will never come out of HUD approved housing counseling agency's mouth. All right. What we're going to tell you to do is, hey, let's submit for this loan modification. But again, when you read these guidelines, it states the individual must demonstrate the hardship. That servicer, that investor must see that hardship. And unfortunately, you continue to make that payment, and you're making that payment, and we're always going to tell you guys, make that payment till you cannot make that payment anymore. We don't want you to gamble with the loan modification process and not make your monthly payment when you actually can. We don't want you to apply for special forbearance because everybody else is getting it when you actually have the funds to make it. So going back to how this impacts the credit is, once you usually apply for a modification, it's because I'm destitute. I have no way to make this monthly payment. And so now that's where the credit becomes affected. Okay. Because one monthly payment missed, Larry, on average, what would you say? And we can't really give you like pinpoint figures in terms of the credit, but what would you say on average it could reduce the individual's credit score?
Yeah, so one missed mortgage payment, it could be anywhere from, it depends on the strength of the individual's credit, but it could be from 50 to 80 points.
Okay. And so when he says the strength of the individual's credit, I'm going to say it like he told me years ago. All right. I think he used you use yourself and I. A lot of times is the strength is really the longevity. So I don't care. I'll say how old I am. I'm 40 years old, right? So my credit may not look the same for a person. Again, I'm old. I'm getting old, y'all. My credit will not look the same of a person who may be in their 60s because they got 20 years on me in terms of building that credit, having that credit for a long period of time. So say, for example, I miss my monthly payment, it could drop, like you said 60 something points. But somebody who has a 20 plus years on me in credit, A1 credit at that, because it's not just 20 years of janky credit. We're talking about 20 years of good credit. So 20 years of good credit, they miss their monthly payment, it may only drop like 10, 15 points. Okay, so keep that in mind. The main thing that we really want to hone in on for everyone who is watching this webinar is don't allow it to get to that point. Reach out to your HUD approved housing counseling agency. You cannot tell me we don't know that we're not going to make this. We don't know that we don't have this money.